Good evening, friends. Once again, a warm welcome to my YouTube channel, Accounting Simplified. And today I am presenting you my fourth video. Today's topic is general terms in bookkeeping and accounting, which we use in our day-to-day life. Recap what we have seen so far in our earlier videos. In the first video, we talked about basics of accounting, why accounting is needed. In the second video, we talked about the rules of accounting. In the third video, we also talked about general entries, how the general entries are passed by taking certain examples. Now in this video, we would talk about general terms which are commonly used in accounting, and we also would try and see the definitions.
These general terms are actually nothing but various terminologies that we use in our day-to-day accounting practice. We would also touch upon the definitions briefly of those general terms. Firstly, we would talk about chart of accounts, popularly also known as COA, full form, as I said, chart of accounts. It's actually nothing but digitalization of the accounts. Because in any accounting package, posting cannot be done via the description of the account. There has to be a code behind that description, that particular account. Just you, me, and many others, they are recognized by their names. Accounts also are recognized by the names, of course, in the background along with a code. So the postings, whenever we pass a general entry, in the third video we saw various entries. There the headings, for example, sales, cash, debtors, creditors, all these terms are backed up by a digital code in the background. So the posting happens based on that code. Clear? Now, next definition is closing of the books. Closing of the books means what? Running a closing procedure at the end of a predetermined period. Period can be 1 week, that period also can be year. But generally in the companies, closing takes place monthly, closing also takes place quarterly, closing also takes place at the end of the year. That is how companies declare their results at the end of the quarter, or say at the end of the year. What happens during closing? All adjustments take place, and along with the adjustments, whatever is the balance in the ledger accounts, those balances are transferred to trial balance. And trial balance is our now next general term which we use in our day-to-day life. Those who are giving, or those who are now in 11th or 12th standard would definitely know this word trial balance, because in the exam paper they are given the trial balance and then they are asked to prepare P&L and balance sheet. So based on the trial balance, where list of all chart of accounts along with the balances thereof, they appear vertically. Format can be anything, but generally they appear vertically, debit and credit. Clear? Let's move to the next slide. Once the trial balance is ready, then next in the pipeline is income statement, also popularly known as profit and loss statement, and then balance sheet. In income statement, on one side, as the name suggests, we show all incomes, and on the other side, we show all the expenses. Expenses would be anything, cost of sales, other cost of sales, other expenses, and on the income side, we mainly show sales and certain other incomes. For example, interest from bank. If rents are coming, then those rents are also shown in income. At cost of sale level, the balancing figure, that is between the sales and the cost of minus cost of sales, you come to know at the gross profit level, and after deducting other expenses, we come to the net profit level. One important thing here to understand and note is all the accounts which form part of income statement, there the balance is not carried forward. Whatever are the postings in those ledger accounts, for example, say travel, the balance as it is at the end of a particular period is transferred to P&L, and that's it. There is no opening balance per se in accounts related to income statement. However, in balance sheet, as the name suggests, all the accounts which are supposed to have balances, for example, all accounts related to assets and liabilities, uh, those accounts form part of balance sheet. Uh, Whatever is the balance as at the end of a particular period is posted to balance sheet and also carried forward to the next accounting period as opening balance. Just to summarize, balance sheet, there would be opening balance, there would be postings during the year, then there would be closing balance, and that closing balance would get posted to balance sheet, and also that closing balance will be opening balance for the next accounting period. Whereas for income statement, there is no opening balance, there is no closing balance to be opening balance for next year. Whatever is the accumulated balance gets transferred to P&L and the account is closed. Clear? Let's move to next terms. Next general term is cost of goods sold. Any expense which are related to production of goods, factory related, are termed as cost of goods sold. Main content would be basically, major would be the raw material cost, the raw material that is being used for producing the finished goods. There could be wages, there could be factory rent, there could be freight for the incoming raw material, and then the sales figure minus cost of goods sold figure would give you gross profit, as we saw in the previous slide. Next would be other expenses, which is not directly related to production, are called other expenses. For example, salary of the salespeople, office rent, then refreshment, communication cost for the offices, that would form part of other expenses. And then gross profit minus all these other expenses, you would come to net profit. Next term commonly used is assets. Assets is nothing but all such uh, items of value basically used for manufacturing of goods or services for resale. Clear? Further details we would do when we touch upon balance sheet. There we would talk more on assets and liabilities. Let's move to the next slide. In the previous slide, we talked about balance sheet. Now here we are talking about certain components of balance sheet. Uh, main main component is capital, also popularly known as share capital. That is nothing but the money brought in by the owner to start and to run the business. As I said earlier, further details when we cover assets and liabilities in a much larger way. Another component is inventory. Inventory is nothing but stock of raw materials which are going to be used for manufacturing purpose, work in progress, finished goods, etc., etc. And last but not the least, depreciation. Depreciation is very interesting and also very popular term, which many times is also being asked during the interviews, and this is also the hot topic for uh, accounting exams. Depreciation is what? Depreciation is nothing but reduction in value of any assets over the usage of that asset. That means as we go on using that asset for, let us say, manufacturing, the life of that asset goes down continuously. That means whatever could be the efficiency in the first year, second year the efficiency would be slightly lesser than the first year, and so on. Best example would be if you have a vehicle, let us say a car. In the first year, the base value for calculating the premium would be 100%. But if you go to the next year, then the cost would be little bit lesser, maybe 25% lesser. If you have bought a car, let us say for 10 lakhs, and you have paid the premium on 10 lakhs in the first year, subsequent year, second year, you would be paying the premium on 7 lakh 50,000 only. The value of car goes down as the days pass by. Same logic is also applied here, and companies are allowed to charge the depreciation to P&L. Why it is a charge? Because depreciation is allowed to be deducted from the profit. It's not a cash expense. It is a non-cash expense. We would cover this much in detail in the coming videos, because I am planning to make a complete video, separate video on depreciation, because this is very important topic. So just to conclude, we can say depreciation is a non-cash expense allowable as a deduction from the profit of the company. Clear? Let's move forward.
As I said earlier, accounting is a time-bound activity. So all accounts needs to be closed at a predefined date. As far as Indian companies are concerned, the accounting period could be from 1st of April to 31st of March. If it's a European company, then accounting period could be from 1st October to 30th of September. And if it is a US based company, then it could be 1st January to 31st of December. But companies are free to select their accounting period for 12 months. That is, for a year, they are free to select their accounting period. However, whatever might be the accounting period that company has selected, as far as taxes are concerned, tax on the profit, as far as taxes are concerned, the government has said the accounting period has to be from 1st of April to 31st of March only. That means companies having other than 1st of April to 31st of March accounting period, they would have to prepare their final accounts 2 times.
Now we come towards end of this video. After having seen the definitions, what I am planning to show you in the coming videos, first would be revenue recognition. Revenue recognition is very important topic. Then we would also see debtors analysis. Therein we would see average days, how to calculate average days, how to calculate debtors turns with respect to the revenue, and various other factors, aging of the debtors, age wise, that is analysis of the debtors. That all we would see. Who is the debtor? As we saw in the earlier video, debtor is a person who owes something to others. Then we would also touch on inventory, and then we would move forward a little bit, I would not say harder, but more interesting and a little bit complex topic, accounting methods. There are various accounting methods when we do bookkeeping and accounting, and depending on the type of product that we manufacture and sell, a particular accounting process or accounting practice is applied to. If it is a standard item, then the accounting process would be different. If it is a project, then accounting process would be different. For project accounting, popularly it is known as POC, that is percentage of completion, and CCM, that is completed contracts method. So all these things we would see in the subsequent videos. So that was it for the current video. I'm sure those who are seeing my video, you must be liking this. So please also like on YouTube, subscribe to my channel for such more interesting videos, and you can also share my video on your YouTube channel. Thank you very much.